Good morning, everybody. So today I'm going to summarize what we covered in the last class. Let's start with these three financial statements. So we looked at what is financial statement, and then we try to summarize what are these three statements. And as a leader, what is your role in terms of adding value to the company? So let's look each of them, and I'll try to summarize it. So in the balance sheet, you'll be looking at what's the financial position of the company. And the income statement talks about, or let's say summarizes about the profitability of the company. And the cash flow statement tells the liquidity position of the company. So let's get deeper and try to understand what exactly I mean. So the first thing what you will be looking at in the balance sheet is when you start a business, first you will try to understand what's the source of income. And when you identify the source of income, you try to create different types of assets. So in that one, we call in accounting terminology, we call this as a fixed asset, and then we call that as a current asset. So fixed assets are those which are immovable in nature and easily you cannot convert this into cash. So the examples of fixed asset could be land, building, machinery, and the current assets are those which you can easily convert into cash. So for example, it could be stocks, or let's say raw materials, or the payments which you have to receive from the customer. So liabilities are those which you have to pay in the short run and the long run. So it basically summarizes what's the financial position of the company. And to be very simple and precise, to keep it very precise, the income statement is nothing but the summary of the revenue and expenditure of the business. So at the end of the bottom line of the income statement talks about what is the profitability of the company. So whereas in the case of the cash flow statement, it summarizes the cash position of the company in three different forms. So one is operating, investment, and financing. So in the operating activities, you will be focusing on what's the uh, income and expenses of a company related to core activity of the business. And the investing activity focuses on what are the expenses which you incur in terms of buying an asset. And it could be a old asset if you are selling, even that you record here in investing activities. And in the financing activities, you'll focus on how you're going to source funds for your business. Either it could be in the form of your own capital, self-financing, self-funding, or it could be through borrowed money. So all these three statements are meant for different purposes and talks about various things. So now let me go with the same example of Claudia and Andrea of starting a pizza business. Okay. So in the last class, we were trying to understand with this simple example. So let me start with this slide. So let's say if Andrea is able to sell 40 pizzas, and per pizza he is charging $5. So which means when you prepare an income statement, you record only the revenues and expenses related to the business. So in this case, so if Andrea is able to sell $40 for 40 pizzas, each of those pizza costing $5. So this $5 what you're seeing, it includes cost paid to Claudia plus the profit of Andrea. So the total revenue of the company is $200. And for each pizza, the cost what Andrea is incurring is $40. So this we specifically call as expenditure. And the total profit of the company is $160. So the basic principles remains the same, income minus expenditure. So now The clarification is why we are not recording this $60 worth of stock. So the reason is in the income statement, the revenue is considered only when you raise a bill, or let's say only when the actual sales happens. So that's why we are not recording that $60 here, because this $60 is recorded in the balance sheet uh, because it's not yet sold. So which means you have the finished goods which is ready to dispatch, but you have not yet sold. So that's why we are not capturing that $60 in income statement, because income statement captures only the aspects or let's say items which is related to or which is, let's say, which happens after the sales, not before the sales. So the $60 still you have not sold, it's still in your factory. So which that's the reason why we are not recording this $60 in income statement and we are showing in balance sheet. And he started with $100, this you already know, so which is nothing but his equity. And the profit what you see here, this is nothing but we have carried forwarded from income statement. Okay, so let's see the same example. So now let's say if Claudia expands his business. So let's start with the balance sheet. That makes more sense. So let's say if the Claudia is expanding his business, then let's see what will be his balance sheet before expanding and after expanding. So 2021, what you're seeing, that was the inception, or let's say when he started the business at that point of time. And then 2022 is when he's expanding the business. So now the point is very important here. So if you see here, he has started with $100, and now so don't worry about too much about the calculation, but what you have to focus is the focus should be on how exactly we are translating these numbers into various types of items in the balance sheet. So that is what you should focus more on. Okay, so let's say now what you have to see is here he's expanding his business, and if you see his equity, or let's say the own funding is also increased, and he has also borrowed 25,000. So in this amount what he has raised from his own capital, that is equity and borrowed money, so he has used these two in creating these assets. So which means, let's say if he's starting a pizza business, he has purchased the building in Al Jazeera Street, for example, which is worth of 100 Qatari riyal, and he has also purchased 10,000 worth of machinery, and also he has purchased a truck. So the point what I would like to emphasize is he has increased his capital and he has borrowed money. From these two sources of financing, he has created these assets. Okay, and here if you see, this is what we call it as a liquid cash which he has in the bank account. So the 50,000, assuming he already the 40,000 he already has money in his account, and this 50,000 what you see in the income statement, that comes and sits here in the bank account, because that's a liquid cash. Okay, and the same thing what you see in the balance sheet under retained earnings. Okay, so here the accounts receivable means the amount which the customers are yet to be paid, or let's say the customer has agreed to pay in the near future. So emphasize what you should, as a leader, you should be looking at is how you are going to, let's say, when you look at the asset side, you should focus on when you're acquiring any asset, how you're going to create the value for the company. And when you're looking at the current assets, specifically stocks and accounts receivable, in these two cases, you have the money but it is blocked. So in that case, you should be prepared enough in managing your short-term expenses, because these two you will receive it sometime future. Okay, and when it comes to liability side, it's the same thing. So the income what you're generating from the business, is it sufficient to pay your short-term expenses. If not, you need to look for the sources where you can mobilize the fund. Okay, and when you look at the borrowings of 25,000, before you borrow or if you decide to borrow any money, you should always understand, if I am borrowing this money, whether my business will be able to generate that much of cash. And as early as possible, you try to pay off this borrowed money. If not, you will end up paying more interest. So the balance sheet focus on summarizing the financial position of the company. So let's go for income statement. So if you look at the income statement of two different years of the same pizza example, so in 2021, if you keep as the base year, you can see here that it is completely blank, because the reason is the Claudia did not have any assets, and he was able to expand it in the next year. So that's why if you see this revenue is nothing but what is the actual sales the company has made during this year. And here, if you see in 2022, you can clearly notice that the company has, almost all weight items in the income statement. This is because the company has used borrowed money and also increased the equity and try to expand its business. Okay, so here, if you see the gross profit, when you see the it's mainly focuses on the efficiency of the company in terms of managing its operating activities. And these are expenses which are related to the core activity of the business. Okay. And if you add these three, you get 30,000. Okay. And here, this is nothing but again the same thing. The principle remains the same, revenue minus expenditure. And the total operating income is 100,000. So the non-operating items are those which are not related to the core activity of the business. So dividend income means the company has invested somewhere and they have got the profits out of it. So dividend is basically the company declares part of the profit to the shareholders in the form of dividend. And the interest expense is nothing but the interest what let's say in this case Andrea is paying to the bank. Okay, so this 1,88,000 is basically, we call this as the amount earnings, or let's say earnings before taxes. Okay, and if you see here, the 50,000 is directly going into balance sheet. That's what you see here, right? And here you see 50,000 and here you see 160 Qatari riyal. So which means the profits are gone to balance sheet. Okay, and coming lastly, the cash flow statement. So the cash flow statement, don't worry too much about the technicalities. So the only difference is the income statement considers the income minus expenditure, whereas cash flow statement focuses on the overall liquidity of the company. So liquidity means what will be the position of the company in terms of managing its short-term expenses. Or in simple words, it means that how much cash you have in your current account. So in this, what we try to do is, if you see this 50,000, so the 50,000 we have picked it from the income statement. You see here, right? This 50,000. So why we are taking this here? Because the income statement, if you see, it considers all expenses which are not actually an expenses. For example, depreciation. If you see, we are adding back here the depreciation. And if you see, we have deducted it because we consider depreciation as an expense in the income statement, but actually, in reality, that is not an expense. We just record in the books of accounts. Okay, so that's why we have added back, but it could be different. What one of you asked was the same. So you were asking about whether the value of the asset is going to deteriorate. Of course, it is going to reduce but you will notice it here. For example, see the example of delivery truck. So this is a fixed asset, right? For example, it could be, let's say, in the case of pizza machine also. So these are fixed assets. So which means when you start using it, the value of the asset will reduce. For example, if you see the company Andrea has sold the older delivery truck. So here, if you see, he is making money of 4,000. So which means cash is coming in. So to summarize, what you have to look is each of these activities you will actually look into actual cash inflow and actual cash outflow. So the definition and how to treat about depreciation and deferred taxes I have put separately in my email and also announcement. So please have a look on that. So so this about the cash flow statement. So I hope I have very shortly summarized what we have completed in the previous class. So please feel free to get in touch with me at any point of time through email or from my office. Thank you so much and happy learning. Take care. Bye bye.